Most retail investors are absolutely terrified of bank stocks right now. They're convinced the entire financial system is cracking under the sheer weight of these elevated interest rates. It's a massive pain point in the market. But what if I told you that one mega bank didn't just survive this environment, but actually turned those high rates into absolute gold? Welcome to this explainer. Last week, I took Bank of America's massive Q1 2026 earnings report and ran it through a deep fundamental analysis framework, looking at it the exact same way legendary investors do. I kept asking myself, looking at this complex, massive balance sheet, is this stock a classic Warren Buffett buy right now, or is it a hidden value trap? Well, by the end of this explainer, you're going to know exactly what the verdict is. We are totally bypassing those dense, 30-plus page SEC filings to give you a clear, actionable framework that you can literally steal and apply to your own portfolio. We're going to peel back the onion on Bank of America's fundamental business performance, looking at exactly how they are navigating these turbulent waters.
Now stop whatever you're doing right now. Seriously, if you own bank stocks or even just casually track the broader economy, you need to hear this staggering number. $30.3 billion. That is Bank of America's total top-line revenue for the first quarter alone. It's a massive pattern interrupt, telling us right out of the gate that this was an absolute monster of a quarter. Think about it. Generating over $30 billion in just 3 months is basically like collecting the GDP of a small country in 90 days. But a number this massive simply doesn't happen in a vacuum, right? It takes an incredibly robust machine running on all cylinders to pull that off. So we really need to unpack exactly how they got here and, more importantly, if it's actually sustainable.
Section 1. The Macro. Let's look at the Q1 headline beat.
So we aren't just seeing revenue climb from $28.2 to $30.3 billion year over year. The truly shocking statistic is actually the bottom line. Net income jumped a massive 17%, moving from $7.4 billion up to $8.6 billion. In a banking environment where everyone and their mother feared severe margin compression, Bank of America actually accelerated, generating 2.9% operating leverage. That is incredibly hard to do.
And it perfectly sets the stage for what CEO Brian Moynihan stated point blank: "I'm bullish on the U.S. economy in 2026. Now, this isn't just fluffy executive optimism. It's the exact foundation for how they achieved a 25% jump in earnings per share, hitting $1.11. When a CEO of this scale signals that kind of confidence, they aren't just talking. It translates directly into aggressive lending and trading across the board. With their corporate identity so firmly established as a premier market leader, you have to remember the sheer scale we are dealing with here. We are talking about a $3.5 trillion asset base. Managing a balance sheet of that magnitude is literally like steering a massive cargo ship through a hurricane of fluctuating interest rates. To pull it off, it requires a perfectly balanced business model.
Which brings us to Section 2. The Micro. The twin engines of revenue.
Bank of America essentially runs on two massive engines. Engine 1 is net interest income. Driven by those higher rates we talked about, it's firing on all cylinders, up 9% to $15.7 billion. But right alongside it, the second engine, non-interest income, was absolutely roaring. It was fueled by a stunning 30% surge in equities trading and a 21% jump in investment banking fees. And these twin engines are working in perfect harmony. When you look at how the total revenue breaks down, it is almost completely even. $15.7 billion from interest streams and $14.5 billion from non-interest streams. This perfect equilibrium right here, this is the holy grail for bank executives. It creates incredibly diversified results that effectively insulate the bank from sudden economic shocks.
But to fuel those engines, you need really cheap funding. And they've got it. They now hold a record 38.5 million consumer checking accounts, and they added over 100,000 net new accounts just this quarter alone. Because over half of these balances sit in low or no interest accounts, they have an incredibly cheap, durable source of capital to deploy back into the market.
Section 3. The friction. Let's look at asset quality and risks.
Even with over $1 trillion in loans, their credit quality remains highly contained. Net charge-offs represent just 48 basis points. That's tiny. And the provision for credit losses actually dropped year over year from $1.5 billion down to $1.3 billion. Non-performing loans represent just 0.5% of their total portfolio. So despite all the doom and gloom out there, the sky is simply not falling on the consumer.
However, let's be real and address those common fears retail investors have, because there are absolutely real risks hiding in the shadows here. Steal this exact watch list for your own framework. First, keep an eye on commercial real estate office exposure. Second, legal reserves tied to Zelle fraud litigation. Third, California wildfire mortgage stress.
And finally, the massive caveat to everything we've discussed. A 100 basis point drop in interest rates could erase $2 billion in net interest income over 12 months. That is huge.
Section 4. The market, valuation, capital returns, and outlook.
So what are they doing with all this cash? The bank is aggressively rewarding its shareholders. They executed $7.2 billion in stock buybacks and paid out $2 billion in dividends just in this quarter alone. And they did all of that while maintaining a bulletproof 11.2% CET1 capital ratio. Basically, they have more than enough cash to perfectly protect the bank, and they're shoveling the excess straight back to the owners.
So where does the stock actually go from here? The bullish consensus from 24/7 Wall Street projects the stock climbing from a $60.48 target right now in 2026, building steadily to a staggering $80.22 by 2030. Analysts are leaning heavily on the continued success and equilibrium of those diversified revenue engines we talked about.
Which brings us to the ultimate crossroads, and the bold question every investor absolutely must weigh. Will a higher-for-longer interest rate environment sustain this incredible net interest income momentum? Or will future Federal Reserve rate cuts eventually compress these massive margins, forcing the bank to rely entirely on its trading and investment banking engines? The fundamental data we've looked at today shows they are built like a fortress to weather the storm, but the macro environment is absolutely going to dictate the pace. Keep this framework in your back pocket as you watch the markets, and keep learning. Thanks for joining me on this explainer.